I am passionate about giving back. My wife and I, we do have our own private foundation where we carry out free medical missions to underserved parts of Africa every year. In terms of stewardship, my faith requires stewardship. It's so important to me, and stewardship for me means being responsible with what you are blessed with.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe that the key to scaling and compounding your wealth in life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and make a bigger impact with your wealth, your life, and everything in between. I'm so excited about our next guest. He is out of the great state of California, kind of where I'm originally from, the Bay Area of California. He's a seasoned CPA who helps entrepreneurs create and preserve wealth through different tax strategies. Today, we're going to be talking about the big, beautiful bill. It just passed 48 hours ago or so, and some of the key things that you're going to want to look at as a business owner, a real estate owner, or entrepreneur, or investor. And for those who don't know me, my name is Brett Swartz. I'm the founder of Capital Gains Tax Solutions, where we're also streaming live. We'll be streaming this to that podcast and YouTube channel as well. But please welcome to the show with me, Mr. Michael, and I'll have him pronounce his last name. Michael, how are we doing today? Yes. It's a great last name, by the way. It's fantastic. By the way, you can learn more about Michael if you want to by going to his website, and that is smeedcpa.com, smeedcpa.com. Michael, for our listeners get to know you for the first time, would you give us just a little more about your story and your current focus?
Yeah, thank you so much, Brett, for having me here today. It's been an exciting journey. Somebody once asked me, how did I get into the business of tax planning? I'm like, it was a very interesting story because when I qualified to become a CPA, I got slammed with a big tax bill. Then I was in corporate America as a controller, and I got a CPA to do my taxes, and I was really shocked when I got the tax bill that he said I owe the IRS. And that got me really thinking and saying, okay, if I sent my taxes to a CPA to do, and I ended up with this big 5-digit tax bill, something is not right with this picture. And that was how I got into tax planning and tax advisory services.
Absolutely amazing. And so let's dive into the right big, beautiful bill. It just passed, and maybe some of the top key takeaways for business owners, entrepreneurs, investors, high net worth capacity leaders. What are you finding in that really sticks out for you?
Yeah, so thank you for that question, Brett. This bill is really, really loaded with a lot of stuff. Now, full disclosure or disclaimer, I am still reading through what is called the Blue Book. Now, most people don't know that when a tax law is passed, there is what is called the Blue Book. The Blue Book is not the Kelly Blue Book that most people are used to. The Blue Book is something that the tax attorneys and the CPAs that are employed by the Senate and the House Joint Tax Committee, they put together. That book pretty much gives you all of the examples that tells you exactly how to really implement what is in the law. So I am not done with that process, but nevertheless, there are lots of good nuggets that I think every investor, every business owner, and to some extent, individuals should pay attention to. So far, I have kind of broken down every of what I have found so far into four categories. I call them winners and losers. Winners for the business owners and investors, losers for business owners and investors. And then on the individual side, with estates and tax planning, there are also a few winners and losers. So I think let's start with the good news, which is what the winners are. Now, I think the big thing many of us have been expecting this for a very long time was the 100% bonus depreciation. Now, with bonus depreciation that has been brought back again, that just means that for every assets that are placed into service after January 19, 2025, you do get the benefit of being able to get 100% bonus depreciation on it. Now, this is expected to really drive capital investments across industry. That's a huge one for most real estate investors. I mean, for any real estate investor, he or she should be talking to their tax advisor at this point in terms of what does this mean for me. And bottom line is what it means is it puts you in a position where you really can depreciate a whole bunch of the depreciable assets that you buy and be able to really bring your taxes down, get more cash flow, and then you go into your next deal. So I think that's a big excitement. I really do expect this will really stimulate the real estate market once again, because I'll say for the last 2 years, everybody has been waiting for this. So I think
Yes.
that's a good news.
Let's dive in on this one, right? We call this tax flow, not just cash flow, right? And
Right.
and a couple of years back, I remember sitting and looking at these multifamily investments, especially in California, and you'd say, how could these people pay these outrageous prices for these properties? And the answer was 100% bonus depreciation at that point was still in effect, and so they were buying it to offset, if they were, especially if they were real estate professional status, these massive tax bills. And so it was almost like reverse taxes, right? You have the positive cash flow, and how can you reverse the tax flow? And so that's what was driving these things. And it's part of what inflated these prices and got to the point with low interest rates, a kind of a perfect storm. And then as it phased out from 100 to 80, 80 to 60, 60 to 40 is where we're at now. And so this is a big boost, because that was a big reason why, especially for investment real estate, and especially in highly appreciated states like a California and New York or New Jersey, like that prices were so high. So yeah, I think it's a good boost, because things have been pretty flatlined for the last couple of years. What do you think?
Absolutely. Again, anytime a real estate investor comes to me, one of the things I'm always driving them to is to look at not just only the cap rate of what they're investing in, but to really look at what is the tax benefit in there. And just like you said, it's really about tax flow, not just cash flow, really, because um, the secret to real estate investing really is to be able to tap into the tax benefits. I mean, the United States have done the best job in the world when it comes to putting in place good tax law for a real estate professional. And that has made it possible for the government not to be the one to be putting money into real estate or housing for the citizens. Okay, so
100%,
yeah,
100%. So
this
let's talk
is
about that. So it's not just real estate. It's also, it could be equipment. It could be private jets. It can
right.
be, walk through this bonus depreciation and then connect the dots for somebody if they're a real estate professional status, and how they can offset active income.
Oh, so again, I am huge when it comes to real estate. In fact, we just designed and we'll be implementing an app for people to track their real estate hours in the next, I think, next 4 weeks. Now, the one thing with being a real estate professional is what is called the whole 750 hours and how and whether or not you qualify. The big deal about it is after 1986, there was this change in tax law, which now meant that if you get real estate activity losses, by default, those losses are deemed to be passive by default, right? And there's just a whole lot of minefield around that. Now, that really kind of put a bomber on a lot of real estate investors. But again, when you begin to dive deep into Section 469 of the tax code, you really find a pathway on how you can qualify to be a real estate investor. Now, that's something every investor needs to sit down with their tax advisor and be sure they know how to qualify for it, because if you don't do it properly, then you definitely will be running a risk. Now,
Yeah,
for the
and
really
so yeah, so because I want to go more stuff on the big beautiful bills. I want to get to the winners, the losers, and the estate. But here's what we're saying: you need to connect with someone like Michael or your CPA. And if they don't understand real estate tax professional status, you need to either pick a new CPA or make sure they get caught up on it. Because the reality is you're missing on the opportunity to offset active income if you can get at least 750 hours. They can maybe be a little bit less if you do Airbnb. We can go down a whole rabbit hole in this, but look up real estate professional status. It doesn't mean you're selling real estate.
no.
Doesn't mean you're a real estate agent per se. Okay, so just realize that it's really like really active investor, manager of real estate. You can document your hours. So go into that. So the point is 100% of bonus depreciation has come back into play. This definitely enhances that real estate professional status to offset your active income and or just even passive income. Even if you can't do real estate professional status, you can still get lots of offset, even massive more offset on passive income. Okay, so that's the number one biggest beautiful part of this bill for the real estate entrepreneur is 100% bonus depreciation. Michael, let's keep moving on because we don't have much time. What's number two?
Number two, still related to this, is the new bonus depreciation for manufacturing qualified property investment. Again, similar, but still a big thing.
Okay.
100%, that is a huge one. A third thing that is really, really big is the research and development tax.
Wait, pause on that second one. You said bonus depreciation for manufacturing. We'll break that down. What does that mean? What do you mean by that?
So what that means is that for manufacturers, okay, who are into kind of doing some capital intensive activity like building factories and all of that, okay? Now for this year, until 2029, they do get 100% bonus depreciation on all of those capital intensive activities that we will be putting out there. So that's a really big one. I think that's very exciting for people who will be into manufacturing. So this is
okay. So manufacturing specifically. So like if you manufacture something in the U.S., that's the goal here, to get manufacturing jobs in the U.S., they will allow bonus depreciation on all of this from 2025 to 2029. Yes. Okay, that's cool. Okay, I like that. Excellent. And then let's go to the third one. You said, what's the third one?
A third one would be something that was there from 2017. It was supposed to sunset by the end of this year, which is the qualified business income deduction. Okay. This is something that was being enjoyed by partnership and S corporation and even sole proprietors that were running business. Now, you get to take off 20% of your taxable income as what is known as the qualified business income deduction. That percentage has just been increased from 20 to 23%. Okay.
Okay, let's walk through that. Let's walk through this. So this is big, right? So I don't know if it phases out, but let's say I made $1 million of revenue or taxable income and I'm a business owner. Are you saying that instead of that, they're going to minus 230,000? So I'm actually only going to be at what's that? 770?
770, right?
Thousand. That's big because I mean, if my tax bracket is, let's call it 35%, right? So that's an instant, on our 230,000 by 230,000 by 35%. I mean, that's 80,000 in tax bill. That's basically gone, right? Is that what we're saying?
Okay. So now there are some planning around every of these things. They are not just there for the taking. Again, they are there, they are nuggets, they are all scattered all over the place. That is why you need to be really very focused and active with your tax advisor at this point. Now, but that is a big one because one, they've made it permanent. They've even increased the percentage. So I am really excited about that because it's really going to help us through business owners to have less taxable income to pay taxes.
That's incredible. Does it phase out if I made 5 million or 10 million?
It's made permanent.
Okay, so it's permanent, but there's no cap.
Oh, there's a phase out. There's a phase out. Okay. Again, because of the phase out, this is where some planning comes into play. Okay. I would take, say, a typical physician or a dentist client. This is where you may want to break out your business instead of just having your dental practice or your physician practice. You could have your administrative company, and that administrative company will be doing non-medical things. All right. That company could be doing administrative things. That company could be responsible for your payroll and stuff like that because there are what we still call specified service business. Now, because of those phase out and those cap, you want to always stay below those cap. And the way to stay is to bifurcate your revenue between your core services and your non-core services. That puts you in a position where for the business that is a pass-through, it puts you in that place where you get that 23% qualified business income deduction.
Okay, that makes sense. And so if you're listening to this, and by the way, if you don't have a great CPA, and you're looking for a great CPA, why don't you go to smeedcpa.com, smeedcpa.com, and get with Michael or one of his team members so they can start to help you with this. And what he's saying is, if you have one big business, one big beautiful S corp, and all of it's rolling through there, perhaps you want to cut it in half and run it through another S corp, and that's only going to do your admin, and then your other thing is going to be doing your other service, and bifurcate your different income streams, and therefore each of those S corps could qualify. Is that a fair summary, Michael?
Yeah, that's perfectly correct. That's the way to go about it. Now, these are
What are the
all
caps? Just curious. Is it 500,000? Is it 250? Is it 2 million? Like what amounts?
Oh, the amounts, I can't remember off the top of my head now, but especially for the medical practice, there is a limit to it. For
Okay.
people in law, in medicine, in architecture,
Okay.
some of the licensed professionals just have this phase out, and I think it's something that they should pay attention to.
Okay. How about a real estate? He owns a bunch of multifamily properties or owns a bunch of industrial properties.
A real estate professional is not among the specified service business, so that phase out per se does not necessarily trap them. But for the
Okay, so they may not have a
specified
limit then. They have no cap if they're running through an S corp.
yes.
Okay, it has to be S corp. Could it be a C corp too?
Again, you go into somewhere in terms of entity. I typically will not run a rental real estate activity through an S corp or a C corp. I'd rather you be running that through a partnership or an LLC filing taxes as a partnership. Okay.
Okay.
So again, this is where there needs to be a good interplay of every of these things so that what you get at the end of the day is what you're wanting to get out of it.
I like it. Okay, good. Yeah, this is we're getting a little weeds. So I'm hearing you, Michael. Let's keep going here. So
Yeah.
we've done
One big
three.
sleeper
Yeah.
there is the section 1202. Now,
Okay.
this is a big one. I know most CPAs are always very big at saying, hey, go form an S corp. Section 1202 pretty much says, look, if you are holding shares in your company and the company's original shares are C corporations, in the past, the rule was if you held those shares for 5 years and that activity qualifies under section 1202, if you sell that company, you literally walk away with zero capital gains tax to pay.
Up to 10 million, right? That's what it used to be?
Yeah, it used to be 10 million for the individual. For that amount has been increased to 15 million.
Okay.
Now, it used to be straight. You got to hold the shares for 5 years. But what they've done now is they've layered it. You could hold the shares for 3 years. That will qualify you for 50%. Hold the shares like that. And then up to 5 years, then you walk away with zero taxes. So, for example, somebody who is in the software industry wanting to build their business and just sell it, you know what? These are ways now you can truly walk away without paying any taxes when you sell your business.
Okay, let me walk through this. Okay, so let's say I start a company and I started as an S corp, right? And I hold it for 5 years. And no, don't do an S corp. You're saying that's,
You
want
cannot. So an S corp will not qualify. It has to be a C corp. In fact, with the new
Right.
section 1202, there's what is called the anti-abuse provision that was built into it. Where in the past, what we used to do is we make you form a C corporation, right? And drop your S corporation to now be owned by the C corp that you just newly formed. Now, with this new provision, they say, no, we don't want to let people get away with that. So we're still looking into this as to how to make people be able to move their existing entity out of where it is and move it into a completely new C corporation.
Got
And then
it.
you can start the countdown to when you can truly sell. You see, investing is a long-term sport. People should not
Yeah.
look at tax planning as just today. You got to look at it in a long-term position and say, all right, what would be my best thing? If I'm going to be able to sell my business for 10 million and walk away without any capital gains tax, I'd rather endure whatever amount of taxes I will be paying every year for the first 3 to 5 years.
Okay, so now so say it one more time. So a C corp, if you have a C corp and you own it for at this point more than 5 years, right? And your company's worth $15 million and you sell it for $15 million and you have zero basis, you're tax free. So that's a huge win. They went from 10 to 15. That's big. And they said, well, even if you sold it within 3 years, we'll give you 50% of that 15 million. So it'll be what, 7.5 million?
Right.
Wow, that's pretty incredible. That's very generous of them. So at this point, why wouldn't you ever wouldn't you always start a C Corp? Like,
No.
would you?
Again, there are some companies or some profession that the law
Mhm,
does not allow to be formed as
mhm,
a qualifying small business corporation,
mhm,
like the
mhm,
practice of accounting, the practice of law. If you are
mm.
in the healthcare space, like a dentist or a physician, if you are in an engineering business or things like
Okay.
that. So, what they've tried to avoid
Mm,
is licensed professionals, right? They never
mhm,
want them to be able to qualify as what we call the small business shares. But for
mm.
many other industries, this is a huge planning opportunity, especially for people in the manufacturing space. They should be able
Mm.
to now begin to think, I need to readjust and make myself become a C corporation and plan my exit such that I can take advantage of
Oh,
this.
I love it. 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 So I'm curious, like, what about a trustee company? If it's not a licensed trustee, does that help? Or is that still kind of fall in the professional service category?
It doesn't fall into the professional. So when I talk about the losers and the winners on the
Mhm.
individual side, I think one of the big things that have come out of this bill is the fact that there is going to be more income tax planning instead of we focusing on estate tax planning. So there's going to
Mm.
be a whole lot of use of what I call non-grantor trust, not just
Mhm.
grantor trust, okay?
Mhm.
Because with non-grantor trust, you can do a whole lot of planning with this new tax law
Mhm.
and help yourself by reducing your income tax significantly.
Okay, this is good. This is good. All right, let's keep moving. We'll keep moving.
All right. So
This
we
is
talked
great.
about
This is great.
1202. Again,
Yeah.
section 12079 expensing
Mhm.
has also increased to
Mhm.
2.5 million in qualified properties. Now that
Mhm.
is a big one. Now, excess business losses, that has been
Okay.
softened. This was a big thing for many people because the way the excess business loss came into being from 2020, it became very restrictive. But now one of the things they've done is they've made it permanent. It was originally set to expire 2028. Secondly, they have also made it to be less restrictive. Now you can carry forward your excess business loss and it can be treated as net operating losses, even though there's still some restriction there. So I think
Mm.
those are some very big things that most business owners should worry about or should be thankful for.
Mhm.
The quick other thing I want to talk about here will be the business interest deduction. Now,
Okay.
there's been changes there. The way they've made the provisions, they've now put it in a way that it's what I call revised EBITDA based limitation, which support capital intensive business, improving access to financing for growth in these next few years.
Okay.
All
Wow.
right.
Okay, that's huge. By the way, everybody, Mr. Michael
Uadiale?
um, Uadiale, it's spelled Uadiale, and you can find him at smeedcpa.com, SMEEDCPA.com. Okay, keep going. What else we got? What
Yeah.
else we got?
So let's talk about the losers here. I
Okay.
think the losers really has been the green energy
Mm.
economy. Okay. With the Inflation Reduction Act, the then government came up with a lot of clean energy incentives. Now, many of those incentives literally have been terminated. They've eliminated the green energy tax credits, including the Section 179, the 45L, and the electric vehicles. So any activities in these areas, they need to be done on or before June 2026. Because if you
Mhm.
don't do them before June 2026, you are out of luck. Okay.
Mhm.
So again, this is why planning is what it needs to be. You got to
So would
look.
you buy a Tesla right now? I mean, or you're like buy it before June 2026, or what do you think? Yeah.
Yeah, so anything you want to do in that green energy space or in the electric vehicle space, you got to do them before June 2026. Okay.
Okay. If you want any
Now,
kind of tax incentive, yeah.
yeah. Another thing again, they've also curtailed what we call the incentive tax credits for clean energy. So any project that you are working on that has any of those clean energy stuff, the construction must begin within 12 months of this law passing.
Okay.
And it needs to be put in service on or before 2027. So
Okay.
these are all things that needs planning. So I would say that's one of the biggest losers when it comes to the
Okay.
investing space. Now let's move
Okay.
on to individuals and
Let's
estates.
do it. Let's do
Okay.
it.
I think the major thing on the individuals and estate side has to do with the exemption amount. Okay, before this tax law came, we were panicking. Everybody was thinking, okay, the estate exemption amount was going to revert to as low as 5 million. With this new law, they have made it permanent at 15 million per person. Okay, so what that really means is when you look at a husband and a wife, you both of them literally have up to 30 million of their estate that can pass on to their beneficiaries without having to worry about taxes. Okay, this is huge because what that does is it really eliminates the middle market estate planning client. But what that means for everybody is they need to refocus on income tax planning instead of worrying themselves so much about estate tax planning.
Okay, this is big, right? So this is estate tax and death tax, right? Which is
Yes.
such a was a brutal one. And so it sounds like it's now permanent, which
Yes.
that's cool. Which interesting when they say permanent, does that mean someone couldn't, another party couldn't come in 4 years from now and switch it? Like I don't know what it means when they say permanent.
Yeah,
I wonder.
with the 2017 tax law, what was
Mhm.
supposed to happen is all of that was supposed to sunset
Yeah, it was
December
going to sunset in
2026.
2026. So in this scenario, as far as we know, it's permanent. It's not set to sunset like the other one was in 2026. It was going to drop to the old numbers.
Yeah,
So this is good news. So 15 million per person. So it's 30 million. Is it going to adjust for inflation every year too?
absolutely. It's
Yeah.
adjusting for inflation. You just took that right out of my mouth. I mean, that makes
Okay.
it even more exciting because when you take a look at that, it just means that that number is going to continue to go up, and proper planning will put everybody in a better position. Now, what that
Okay.
really means is that for most people, they should be thinking of how to do more income shifting using trust to expand their deductions, using trust to stack up what I call the QSBS shares, using trust to maximize your Section 199A that deductions, using trust to save on state income tax. So for me, income tax planning is not the new estate tax planning.
Okay. By the way, let's go into that a little bit here, right? Part of what we do here at Capital Gains Tax Solutions is give people a creative alternative to the 1031 exchange, also eliminate the estate tax with a strategy that doesn't require any insurance, no life insurance, no gifting, no lifetime, it doesn't give up, no charity required. And it happens all in one day, all in one sale. I grew up in the Bay Area building houses with my dad all through Silicon Valley, the Bay Area, all these big, beautiful places. And I imagine that a lot of folks that have a greater net worth than 30 million married, they think they're going to just wait until they die and get a stepped up basis. And then, I don't have to worry about tax. Well, it's true for capital gains tax, but it's not true for the estate tax. And so this is where these trusts come into play.
Yes,
So I'm curious, Michael, like, we offer something called a deferred sales trust.
that's correct.
Okay. And it gives people the ability to do a regular installment sale, and anything below 10 million is per married couple per year is the typical amount. But we have a 2.0 version that's something outside of installment sale planning, but it literally eliminates the estate tax. I'll give you an example. We had a $25 million client. They were selling a $5 million asset in Colorado, and we moved it into our plus, our 2.0 version. We eliminated that estate tax, no life insurance, no gifting, no charity required, all in one day, all in one sale. I want to pass it to you. I haven't yet to see anything that's like that, that's so efficient, all in one day, all in one sale. No charity, life insurance, gifting required. I'm wondering what do you have? If someone has $100 million apartment complex and we'll call it 130 million to keep it simple, $130 million apartment complex in San Francisco.
Okay.
They're like, Michael, it's all inside my taxable estate. I want to get it out. Like, what do you do? What do you do?
So when a situation like that, if it's funny you mentioned it, that kind of situation, because we have a retired physician who is exactly in that kind of situation right now, and his two sons, one of them is also a surgeon. The first thing you want to do is take all of those buildings or those real estate out of his individual name and put them into entities. Okay.
Okay.
And then those entities, you want to then do a valuation on them and possibly compress the value of that. Because again, when you do a valuation on that LLC, as an example, you can compress or depress that valuation by up to 20 or 30% by way of illiquidity of not being able to market those shares, okay? That will take away quite a significant amount of value out of that estate, okay? You're just transferring a building you own in your own name, you transferring it into an LLC, right? And then you value that LLC. Now that, yes, that building, like you said, is 130 million. Now, if you're able to chop off 20 to 30% of the value of that by reason of the valuation, you've saved significantly already on taxes.
Yep.
Okay.
Without having to sell anything, just transfer it to a different entity.
Exactly.
Does that trigger a new property tax?
Oh, in California, it does. In California, it may trigger. It may, because there's what is called the PCOR in California, where when you make a transfer from yourself to an entity, that creates that property tax issue. But again, when it comes to taxes, you want to always run your cash flow. What is the net effect of increase in property tax?
Okay, so just to clarify, let's imagine I had on this $130 million apartment complex that I bought in 1950. You know, it's old, there's no basis. And I'm like, it's in my individual name. And so then I transfer to these entities to do your thing. But that can trigger a property tax that is now 130 million, right? Or I guess the value, the 20 to 30% of that value.
Right.
So let's call it 90 million. But still, like, I mean, my basis could have been based upon 20 or 25 million. So you got to be aware of that, right? That is one of the downsides of this. But keep going.
Not all states have that, but California is one risky state where such a thing exists. But I think the estate planning part for this new law, it's really exciting to most people. So most people need to not worry so much.
Okay, keep going. Let's just keep going on this.
Now,
You'll figure
the
that
other
out.
big one there is the SALT increase. Everybody was aware of that one, from 10,000 to 40K. No.
I want to keep going on the estate tax thing. That's what I meant by that. So once you transfer the entities, you get revaluation, you get 20, 30% discount.
Right.
Then what do you do?
Okay, then at that point in time, you cannot be doing gifting out of that LLC.
Okay, so you gift up to the 30 million.
Yeah, you start gifting out the estate to your beneficiaries.
Yeah.
Okay.
X amount per year was like 17,000 per kid per year or something like that.
But again, there is a way to work all of that. You can set up gift trust for your kids, even if they are adult kids, and then you start gifting shares to them.
Got it, every year. So you're doing that.
Because what you are doing with that is you are slowly liquidating your estate.
Right. And you're getting your estate, your 30 million exemption, if you're married, right?
Right.
You and your wife are gifting.
Exactly.
Okay. So now you've got another 30 out. Okay. Now what?
Okay. So that is down. So my point is there is a roadmap for this. Okay.
Okay, so here's the problem. Michael. I've got a health concern. I'm dying in 2 years, right? I've got this health thing where I'm 85 years old. I don't know how much time I have left. So I think this is that all sounds like a plan, but it's not very fast, right?
So the case I am working on right now, the retired doctor, he's a 92-year-old man. He just had a heart attack 4 months ago while we were in the middle of the plan. I'm giving you a real life situation. Okay?
Yes.
So my point there is there are ways to get it done and liquidate everything within a short time frame. For example, that's where you combine both your income and your estate tax. If in a situation like that, you should be considering having a SLAT, okay, which is called a spousal life assets trust. Okay, because what that does is if you have a situation where there's a husband and a wife, right, with a SLAT, you literally put yourselves in a position where when one person dies, everything is moving to the other person, and that other existing partner still hopefully has some more time to start the liquidation process.
Okay, so by the way, slats, cruts, dings, like all of these things, they have their place. And I love them, right? I love them, especially if you have the time and you feel like you have the health and you have the things, right? I just want to make it really simple for everyone in case you're curious, okay? And in case you're running out of time and you're having a heart attack, like this is serious stuff, right? Because the government is going to take 40% on anything above the exemption amounts. So here's what we have. It's called the DST 2.0. So in one sale and one day, without any gifting, without any life insurance, it needs to be selling to a person, like a third party, right? Whatever, right?
Yes.
Doesn't matter if it's in your name or not in entities or whatever. We can forever eliminate the estate tax, and the children are the beneficiaries. Okay, and that's it. And we just sell it. And there's no charity, life insurance, or gifting required. It doesn't take up any of the 30 million exemption. You don't have to give it away to charity. And you don't have to buy any like life insurance. It can be expensive. And so if anyone wants to learn about that, please go to capitalgainstaxers.com. And as well, if you want to learn about the slats and the different things, you should talk to me and Michael, and let's compare notes and let's see what's a good fit for you. But this is just so important that people know that there's options out there. Whatever you do, don't just sit and not do anything. Make sure you're getting professional legal advice to set all these things up. Any last thoughts on that, Michael?
Yeah. Oh, yeah. No, I understand your DST approach. It's a great one.
Yeah.
It's a good strategy. Unfortunately, the only downside to that is most people do not plan ahead. With a DST, the IRS has begun to look at that a whole lot more closely. They want it to be something that is really planned ahead of time, because what they feel is like, they are trying to consider it to becoming tax shelters or listed transactions. So I think it's still a very workable strategy. I love it.
Let me pause you there. So here this is interesting, right? Because we get this objection quite a bit, right? So you're right. You got to make sure you set it up prior to the close of escrow and prior to the buyer removing all contingencies, right? That's important. Yes, that's 100%. The second thing is, we've actually never been on a watch list, never been on the Dirty Dozen, never had a single change in any of the audits. Okay. Now there's been some similar transactions that try to copycat us, that go outside the guardrails. One of them was the monetized installment sale, which got blown up at IRS court. It's a disaster. We've never used that. And they would say it's a loan. And you go, oh yeah, it's a loan. And they go, yeah, but you can have the money in your personal account and do whatever you want with it. You're like, that doesn't make any sense. Isn't that constructive receipt? That's never a loan, right? And so so we get thrown in there. I'm going to just clear the record, right? This is not, we don't do that. I'm a third party trustee. We set everything up prior to the close of escrow. It's never been on the watch list, never been on the Dirty Dozen. And in fact, it's going on over 28 years, thousands of transactions, billions and billions and billions and billions of assets sold using it, and about 2.5 dozen audits, and we've never had a change. And so that's the key. Now you want to make sure you're working with us, who have the legal track record and the audit defense and all of the things with the CPA and tax attorney that we work with, so that everything is created equal there. But like anything else, right? If you don't do an IRA or a 401k or a 1031 exchange correctly, it doesn't mean the 1031 IRA or 401k doesn't work. It means that the practitioner is not the practitioner you should be using, and they failed you, right? So that's the key thing that you want to look out for, right? If that makes sense.
Yep. That's absolutely right. So that's the only thing there about the DST that you just talked about. Great strategy. It's a very awesome one. Sometimes, unfortunately, you will find people do not have the flexibility to move stuff the way it will work for a DST. I just had a client who closed on the sale of an $18 million shares in a company. Now, he didn't have the flexibility of being able to set up this whole structure the way Brett,
he ran out of time,
because the guys who bought their business didn't want to give them that flexibility. So there are times where it will not work, not because it's not a workable scheme, but just because the particular profile of the client does not fit.
We face this every single day, where the buyer won't cooperate or different things and all the things, and so we've got to go in there and we got to educate the buyer's counsel. And we went through the exact same situation, and there is ways around that, by the way, that we've worked out on, depending on the case and on the deal and what they're selling. But we've done it with dentists, optometrists, veterinarians, car dealerships, Bitcoin. We're the first to ever do it with Bitcoin. Manufacturing companies, helicopters, planes, of course, real estate, primary homes. So anyways, enough about that. This is great. Okay, let's keep going. Anything else that we want to add about the big, beautiful bill? Or do we cover it pretty good?
Yeah, I think the main thing for the individuals will be on the SALT. Now that has increased to 40,000, at least for people earning below 500,000, because if you are making above 500,000, there is a limitation on how much salt you are able to get. Okay. Even though
Okay.
it has increased to 40,000, again, this is where the planning opportunity comes into play.
Starts to phase out. So if you're making
Yeah.
more than 500,000, that $40,000 salt
Right.
deduction, which is used to be or is going to be an offset on your federal taxes from the property taxes that you're paying in your existing state. It'll start to phase out after 500,000. So maybe you want to look at ways, like you said, income tax. How can we get that down? Maybe do some bonus depreciation. The real estate professional, like how do we get below 500? It seems to be the number. Is that a fair summary?
Exactly. That's a very fair summary. So that's some of the planning opportunities out there. Again, for the middle class deductions, there are new deductions for overtime pay, car loan interest if you are buying a made in America auto, exclusion of tips for people earning up to 160. But
no tax on tips. No tax on tips. Social Security stuff. Yeah.
So,
Michael, this has been awesome. Let's do the lightning round. You ready?
Yeah.
All right. Number one book you read in the last year.
Amp It Up.
Say it again.
Amp It Up.
Okay, amped it off. Okay, excellent. Question number two. Number one way you're using ChatGPT.
Ask that question again.
Like AI. Number one way you're using ChatGPT or AI.
Number one way I use it.
Yeah.
Oh, I use it 150% every day for tax research. It's my Google now. Okay.
Awesome.
The first thing I always will do with ChatGPT is to go through in my question there, and I get my right tax court cases and the right code, and then I go do the deeper research.
Perfect. Love it. Very last question because we're out of time. What's the number one way you practice a mindset of stewardship over ownership? And what's something you're really passionate about giving back?
I am passionate about giving back. My wife and I, we do have our own private foundation where we carry out free medical missions to underserved parts of Africa every year.
Beautiful.
In terms of stewardship, my faith requires stewardship. It's so important to me. And stewardship for me means being responsible with what you are blessed with.
Oh, God bless you, Michael. It's been such a pleasure I felt like we covered so much in 43 minutes.
I know. We should do this again.
We should definitely do it again. I had too much fun. Please, everybody, if you want to get with Michael, where can they find you?
They can find me easily on our website, smedcpa.com. That's SMEEDCPA.com. My email address is taxes, TAX as in zeros, ES at smedcpa.com. Once you shoot an email there, you will get a hold of me.
Perfect. And all of our listeners, I want to thank you for listening to the Build Up to Billions podcast, as well as for streaming on Capital Gains Tax Solutions podcast and YouTube channels. We're here to help you as we learn as well from amazing people like Michael to scale, compound our wealth in life so we can give more all of it away to help MVPs make a big impact. Go out there, take this information and take action, do tax planning. Don't get caught behind the big, beautiful bill. Ride the wave the best you can as the entrepreneur, as the investor. Take advantage, do the planning, be a great steward with the wealth you're building. Appreciate everyone out there, and we'll talk to everyone again real soon. Bye now.